Hey everyone, welcome. It is 1 p.m. on February 28th. We just got the closing bell. I apologize for missing this morning. Rosalind, my wife, she had a procedure done yesterday, and there was a lot of medications that she has to be on right now. So I was dealing with that, trying to get that organized and jumbled and not jumbled up this morning. So I missed. We have that pretty much down, so it shouldn't be a problem going forward. Today in the markets, it feels kind of bearish. I don't know if you were watching it, but it felt like a very bearish tone in the markets. However, we want to evaluate it objectively, not just go by feeling, even though there is a bearish feeling to it. Objectively, when we take a look, I don't think it was that bad. What we want to do is see where money is moving and whether or not that money movement indicates anything for the stock markets. So let's go ahead and take a look how the trading action was today, and then we can start seeing see if there's any story that is developing. And the other thing that happened was an interesting movement error or glitch in Coinbase. So we'll talk about that. Actually, we might as well talk about that first. When we look at Bitcoin and all the other cryptos, you can see how this thing has just been going crazy, like beyond parabolic, just shooting straight up. You see that? So the last couple of days we had a gap. That's okay. That's normal movement. Today's movement was absolutely abnormal. I wouldn't say yesterday's was normal, but at least it's not, oh my gosh, this never happens. This movement today was very much like that. Crypto really started to fly away, and then we saw a glitch in Coinbase. Coinbase down. So today there was Coinbase shut down. Okay, I'm not sure why this is. Maybe I'm just using a wrong browser over here. Let's go to Google and Coinbase down. Okay, see a whole bunch of users when they saw $0 balances, they weren't able to trade. So I don't know about you, but that reminds me of when GameStop was going through this wild, that Wall Street bets that squeeze upwards, and then Robinhood halted trading. Not all the exchanges, just Robinhood. And that threw a monkey wrench in everything. And then markets were able to come back down, and the prices started to come back down. So this is too similar to what happened not too long ago in GameStop. And what it feels like is there's probably some institution or a group of institutions that were getting creamed by this movement, and they somehow convinced or went in and manipulated Coinbase to shut down and halt trading. That, of course, is highly illegal. Robinhood had to go through a huge congressional hearing in order to investigate what happened over there. Nothing came of it, but this is not looking great for Coinbase or for institutions that might have influenced Coinbase. Now, I'm just purely speculating. I have no evidence that this is the case, but it's just too similar. It's just too similar to what happened to GameStop and to not draw the parallel. Whether or not there would be actually end up being any punitive measurements, we'll have to see. The consequences came to Robinhood from their part, or Citadel from their part in influencing Robinhood. But, it just leaves a bad taste in everyone's mouth when things like this happen. So this is something that I'm going to be paying attention to be aware of. Well, in my groups, we were in a Bitcoin trade. We caught this movement upwards and the overnight movement yesterday, and then we were out. But obviously, there was still a lot of interest in Bitcoin today. But we got a doji candle, another doji candle right here. This is maybe because a lot of people weren't able to trade, but whatever the case, this is an indicator that things are oversold and they're probably going to come back down. And without Coinbase going down, maybe it would have surged up a little bit more, but this type of movement ultimately is not sustainable and it is going to come crashing back down. So we're just getting it maybe a little bit earlier than we would have if Coinbase had stayed up. So this is one of the areas that was sucking money away from the markets today. If I look at the SPY, SPY is down. It's a little green bar right there, but it's actually down 0.14%, not a huge amount. It's really just about chopping sideways. And what you see is that it kind of pulled back, not even quite to the EMA 8. So the S&P is still really, really strong, even though it felt like we are bearish the whole day. If we look at our chart, the range is so small and so limited. It was not even a $2 range in the S&P 500, which is pretty small for the SPY. And we moved up, we moved down, we moved down. So really just mostly sideways trading today in the S&P 500. We actually ended a little bit higher than we closed, which is why we have a green bar. So this overall picture is just chopping sideways, not very, maybe, or you could say very extremely slow pullback down into this EMA 20 region or this trend line right here. But really, I would just call that chopping sideways. So our analysis over the last couple of days that it was starting to look a little bit more likely that we're going to chop sideways into the trend line, and the psychological resistance is going to hold, and today's price movement held up that theory. So we'll see. We could come down and come through this EMA 8, but so far this market has been really resilient and really strong. So if we look at QQQ actually came and touched its EMA 8, but of course the trend line, I guess I should probably adjust now to, we'll just call it the EMA 20, but that distance between EMA 8 and EMA 20 is not that far. So that's not really it's sort of nitpicking at this point. But we could conceivably, even in just one day, fall through that EMA 8 and reach the EMA 20 and this trend line all at the same time. So we'll watch that very carefully. A lot of money has been moving out of big tech or big cap tech as well. So if I look at Google, right, Google is down, okay, down into its MA 150. Should delete these. All right, so that's not looking super positive. If I look at Apple, same thing, broke below its MA 200. So big cap tech is not looking great. Obviously, NVIDIA is still very strong. Hasn't quite come back to its EMA 8 yet. Let's take a look at Amazon. Amazon's still very strong, right at its EMA 8. Microsoft at its EMA 20, which is similar to its EMA 8. And then we've got Meta. Meta is still strong at its EMA 8. So mixed bag among the large caps tech. Some of them are still very strong. Some of them are pulling back and showing signs of weakness. So we'll see. We'll see which one wins out, whether that weakness bleeds into the rest of them, and we get a break of this trend. In any case, we should get a decision by the end of next week. I would think we would either have broken up to new highs or pulled back down to or below the EMA 20 over here. Let's look at the Dow Jones. Dow Jones is completely flat at 0.00%. You can see that we opened below in between the EMA 8 and the EMA 20 this morning, and then we just traded upwards. Let's see how smooth and steady that upward movement was. Not that steady at all. Up, then sideways, drifting down, then up again. So what we see is that intraday, we had a resistance level right here, which is very similar to the yesterday's close. And that's actually where we closed, exact same as yesterday's close. Today's close was exact same as yesterday's close. But they're just below that close level right there. That was a very strong resistance throughout the day. We came and bumped against it 3 times. And you can see that even though last minute we broke above, after hours we're back down below it. So that's going to be an interesting level to watch tomorrow. Let me save that, make sure that stays there. because if we were seeing that much resistance right there, this is obviously an important level yesterday as well. So there's going to be a lot of supply here. There's going to be people who will take advantage of this level, and it could even be market makers. We don't know if are these high volume bars. Let's see. There's some pretty high volume very close to it, not quite exactly at the levels. End of day, last bar I don't count because that always gets a surge of volume. We'll have to watch it very carefully. It's hard to say right now, but it was an important level today. And if we can't get above it tomorrow, that's going to be very bearish for the Dow Jones Industrials, which means, we've been having this sector flip-flop, tech and defensive, tech and defensive. And this week we are back onto tech. And the beginning 2 days, it seemed, even though tech did outperform, we still drifted downwards or just went sideways in the QQQ. So it's not that strong. It's just that it's stronger than the defensive sectors. So the question is, where's money going? If it's not going to defensive sectors and it's not really going into tech, where is it going? Is it money just not coming in? Or is money actually flowing out from the defensive sectors into something else? Bitcoin gave us a clue. Bitcoin obviously was receiving a lot of money. Let's take a look at the volume in our overall indices as well. Yeah, the last few days have just been really low on volume. So this market is waiting for something. The institutions are waiting for something right here. And when they see that something happen, that's when we're going to see that volume. Right now, that is probably going to be a break of this psychological resistance to the upside, in which case we'll see large price action and large volume bars to the upside, or a breaking down of that EMA 20, in which case we'll see a large downward volume and a large red volume bar down here, or it could be even waiting for the MA 50 though. We might see mild volume to the downside until we hit the MA 50 and then strong volume. It could be any combination of those two. Either way, that would be, obviously, it would be bearish for the market if either of those two scenarios happened. Right now, it's going to be unlikely. Even if I see a large volume bar and a large green bar upwards above the psychological resistance, I'm going to be super cautious because that could simply be capitulation. And capitulation means that there's a bunch of people who can't stand it anymore. They watch the market go up and go up and go up and go, oh my God, it's making another all-time high. And a whole bunch of retail traders rush in. And that is where institutions, they sell off the last of their inventory. And then the market starts to go down with conviction. So if we see that happen, we're going to be very, very cautious. We're not going to be over exuberant and say, oh my God, this bull market just keeps on getting better and better. I'm going to say, no, we moved 25%. Inventories in the market makers' hands must be getting pretty low. So that could be the last hurrah where they finally sell off the last of their inventory. And then they've got to start accumulating inventory again, which means what? They're not going to buy it at all-time highs. They're going to wait for this market to come down to some acceptable level to them, which generally means a correction, which would be about 10%, which would bring us to, from this level, it would bring us to about that MA 150 or that MA 200. So that's where we would expect to have large amounts of accumulation from the market makers once again, if we're going to stay in a bull market. If we're going to flop to a bear market, then it'll go below that MA 200. But everything I'm saying is a little bit speculative. It's a little too far in the future. For now, we just want to be very careful. Even if we see signs of extreme bullishness, we want to take it with a grain of salt, given where we are in the markets right now. Because this is not this movement. So I said the other day, well, slopes are hard to gauge because if I change the scale of my chart, obviously this slope looks like it's maybe like 30 degrees, and now it looks like it's almost 80 degrees, right? It's just from changing the time scale, and of course I can change the price scale, and the same thing happens. So the slope of a movement or a trend is not that meaningful unless you lock the scale down and then you're comparing it to a different period. So if I look at this scale and I don't change it, I say I'm not going to change the time axis or the price axis. Now I'm going to compare this uptrend with this uptrend. Well, the current uptrend is significantly steeper than this uptrend right here. It's steeper than this uptrend right here. Let's see if I can find another one. It's steeper than this uptrend right here. It's steeper than this uptrend right here. It is, in recent years, the most, now I'm changing the scale again, but what I'm doing is I'm trying to compare, just as long as I can still see all of them. You can see how these have, well, the last two have been significantly steeper, but they've gotten a little bit more and more steep. But this one's significantly steeper than all the ones that I just drew. So this is fast movement, and unless there's a huge amount of money that has entered the markets, then it's not sustainable. So we could argue that in 2020 or 2021 during COVID, when everyone had nothing to do, there was a large amount of money that entered the markets that wasn't there before. That was also very close to the time where we started getting zero commission trades in the United States. That was enticing a lot of money into the markets. We had Robinhood that pioneered zero commission trades. So a lot of people who previously were not investing in the stock market suddenly put their cash in the stock market, and it became a little bit more accessible to the common person, which a lot of people think maybe, yes, it is good, but for institutions and money market makers, it's like a whole pool of brand new people with zero experience that they can take money from. So what we're saying is, like, from this period, from October of last year all the way till now, was there a huge influx of money into the markets? Like, I don't know. I don't think so. I think we're pretty much playing with the same money that we have been in the last, say, since 2022. Pretty much the same pool of money. So we don't have a huge influx of cash into the markets. And that means the ability for these markets to keep on moving up. So, for example, why did this go on for so long? And this would go on for so long versus these two short ones? Because we had a huge influx of money coming in from right here. This one, we had a huge influx of money coming in from COVID, all the government assistance, all this money that was printed during that time. So this ended up being sustainable because of all that money that was printed and then entered into the stock market. We didn't have anything like that here. Here we are talking about cutting back and raising rates. We're in a period of raising rates and sucking money potentially out of the market. But the upward movement is going to be limited then by the cash pool, or the pool of cash that's available to the market. So this 25% move, I think, is a pretty hard limit. We could maybe see 30%, but 25 is going to be, it feels like it's going to be hard to surpass. So I would not be surprised at all if we start coming down and we see market makers starting to unload their inventory and start to load up on their cash again. So we're going to be very careful. We're still going to point our portfolios upwards for now, but I'm getting a little bit more neutral. I'm holding less positions at one time. I am allocating appropriately so that we're not pointed super to the bull side. and I am picking my sectors very carefully on the ones that should be more resilient if we get a pullback. That way I have a little bit more time to react. If I go bullish on tech right now, even if I go in on small size, and tech is probably the most likely one to break and lead the way down, then what happens is I might get this sudden break and then my portfolio gets hurt quite a bit. But just say the QQQ goes down 3% in one day. Then my portfolio takes a big hit. But on the same day that QQQ goes down 3%, consumer staples might only go down 1%. Then I don't get hurt quite as bad in my portfolio. And then I can respond at that time and put on a hedge or take off my positions and go flat or whatever it is I feel is appropriate at that point in time. And which means I had more time to react and respond before my portfolio took a big hit. So choosing the sectors right now is going to be very important. So we want to have sectors that can still take advantage of upward movement in the markets in case that we continue this uptrend. And we want to not get hurt as bad on the way down so that we have time to react. So let's take a look at what those sectors might be. So let's just see, let's look over the last, I guess that's 2 months. Let's over 1 month. Retail, home builders, semiconductors, discretionary. And we also have industrials and healthcare up here. That's really interesting that those are up there with these highly speculative sectors. And then we'll take a 1 month. Oh, that was 1 month. We'll take a look at the 2-week. Retail, basic materials, home builders, financials. Okay, so a lot more mixed bag right here. And consumer discretionary is significantly lower. So we'll take a look at the last 1 week. Retail, home builders, technology, discretionary. So this is what we were talking about. This week, it seems like we are very much back into the tech heavy or heavily favoring tech. And then if we look at today, aerospace, that's interesting. Aerospace, retail, bonds. I'll take a look at what happened in bonds in just a moment. Consumer discretionary, financials, basic materials. So I'm seeing basic materials be fairly consistently near the top, not necessarily at the top, but near the top across several, today. Let's take a look at the 1 week again. Where's my basic materials? It's a little bit more middle of the road. And then I've got on my 2 week basis, it's at the top. And then on my 1 month basis, it's at the top. On my 2 month basis, it is middle. So it seems to be performing pretty well. So just based on the rank order, I might favor basic materials. We'll look at a chart in a moment. But let's look at TLT first before I forget. Okay, TLT back up again. So it's really just chopping in this region. So most likely until we see this break either side to the upside or downside, we won't see a breakout or breakdown inside the major indices either. Let's look at VIX. VIX up a little bit today. Okay, and let's go back to those sectors. So what I want is a sector that can stay strong even if tech starts to break down. XLV looks like a great candidate. This has been super strong. It looks almost exactly like that. Look at semiconductors. It looks almost the exact same. It has a perfect rainbow, just like semiconductors. Semiconductors came down and touched that MA200 back in November. It was up ever since. Here, back in November, that low was significantly below that MA200, and then we started moving up. But ever since then, it looks the exact same. It's just shifted down relative to all of its moving averages. So basically what we're saying is it got a later start, but it's looking great. So I would be very happy with XLV. Communications never even touches MA200. It is strong relative to the semiconductors, at least November to now, or back in November it was, starting to show sideways consolidation over here. So this could be distribution by the market makers. And once they're done distributing, that'll come down. This is, I didn't notice how flat this looked over here. This is looking a lot like distribution in XLC. Yeah. So what I want to start looking for is a lot of doji candles, which we're kind of getting. And then what I want to see is more of these hammer candles where I've got a long wick, a short shadow, and a tiny body. When I start to see more of those show up, then I'm going to know that that's probably the end for XLC, or we're getting close to the end for XLC. And then I would expect that to drop downwards. And we got Meta. Meta is an XLC. I believe Google is an XLC. So this is starting to make me more wary in XLC. Okay, and let's look at financials. Financials look really good. Also, similar to XLV, my only concern is small regional banks. We had that crisis about a year ago, or the potential crisis about a year ago, where a few small regional banks got shut down, basically. I don't think that's the end of the story. We've kind of put our head in the sand of the last year, but those troubles are not over. There's still a lot of banks hanging on to bonds that lost quite a bit of money. We've been helped by the fact that it's kind of been chopping sideways. So if I look about a year ago, we're still down pretty far from where we were a year ago. So a year ago, we said, oh my gosh, look, they lost all this money. And so those regional banks collapsed. Well, it's down even more from there. So it's not a better situation for them right now. So I'm wary of going into financials at this point in time. So right now, still XLV is my favorite sector. Industrials is looking pretty good. I like industrials. Staples looks pretty good. It only just barely got above its MA200, pulled back to it, and went back up. But this is a nice trend right here. So this looks like even earlier. So also started on this uptrend along at the same time as all the other sectors and the S&P 500, but it only just got above its MA200 just now. Now, that's not necessarily great news. It means that it's been lagging quite a bit. It was significantly weaker during this period of time where it pulled back, but it is showing strength. And I think obviously it's a defensive sector. It can continue to show strength, or at least it'll fall less quickly relative to the tech sector if we break down. So I would say I'll give XLP a pass, XLI, XLV. Really, we were just talking about XLB. XLB is looking pretty good too. When it did very well early on, then it had a sharper pullback. So during this time period where all the indices were going up and a lot of these sectors were going up, XLB was actually going down. And it wasn't until February, so just the last few weeks, where this started to really move upwards. That's really interesting. as well. So B, I, V, P. Those are the ones that I'd be looking at. XLB, XLI, XLB, XLI. I'd wait for a baby pullback though. XLP, XLV, XLV. Yeah, I'd be a lot more comfortable with a pullback. If the XLV gets to its EMA 20, XLB also, maybe the EMA 8, but probably the EMA 20, XLI, pull back to the EMA 8, might be okay with that, or the EMA 20, and then XLP. We don't say BIVP, XLB, XLI, XLP, XLV. Yeah, okay, so we covered all of them. So be careful is everything that I'm seeing right now. Be careful, especially after what I saw in XLC. We have been in a consolidation period. Okay, we have been chopping in this horizontal period for some time now. We have had a few doji candles. We've had a baby hammer candle right here. And this is just showing me that it's going to be very tough for the communication sector to continue to move upwards. Let's see exactly what is in XLC. Meta and Google are by far. Okay, so, but also Netflix, Disney, T-Mobile, Netflix. Might be just beginning to enter consolidation. Disney is definitely in consolidation. We had gap up and then consolidating. T-Mobile has been consolidating for a long time. And Google. Google is not even, it's just weak. It's just been coming down. So I'd be very careful. I'd be very careful. When we see XLC, or I shouldn't say when, but if we see XLC break down and head towards that MA50, then in XLK, we were very likely going to see similar. XLK has been, okay, I can consider that a consolidation also. Just notice that. Interesting. SMH. SMH obviously directional, but we could maybe begin to consolidate right here over the last week. So there are signs. There are signs that we're topping out right here. So I'd be very, very careful. So we still go with the trend. We still point our portfolios upwards. We just want to be very careful which sectors we are in when we're pointing them upwards. And then we want to be nimble. So either we start hedging ourselves as we get closer to these uptrends, or we flatten ourselves out, or we just baby allocate so that our portfolios aren't hurt too badly if we break below, and it gives us enough time to react and start reallocating our portfolios. So a lot more signs of us topping out than before, or at least we're noticing more signs than maybe some of the signs were there and we just didn't pick up on them before. But this psychological resistance, number 2 right here, is proving to be pretty strong, and we'll see. We'll see, or we've got another week. Like I said, another week before, for sure, I should say, for sure we will know by the end of next week. So for now, we just wait until we actually know for sure. Okay. So that is it. That was pretty thorough and actually pretty long. I talked a lot longer than I noticed. Thanks for sticking with me, and I will see you tomorrow morning.